In today's video, we are going to be talking about the candlestick pattern. This is a comprehensive guide on mastering candlestick patterns. So if you truly want to master candlestick pattern, you have to make sure that you watch this video from the beginning to the end, because you are going to learn a lot from today's video. So with candlestick pattern, you can be able to read the price chart and be able to trade the forex market profitably. There are several candlestick patterns, but we are going to look at the important ones. We're not going to treat them all. We are going to pick the ones that are reliable, the ones that are most accurate. So that are the ones that we're going to treat in this video. So my advice for you guys is to make sure that you watch this video from the beginning to the end, so that you will understand candlestick pattern and how you can be able to spot them on a price chart. Have it at the back of your mind that candlestick pattern are one of the price action trading techniques that traders use to make money consistently in the forex market. So like I said, this video is going to be educative, informative and interactive. So pay clear attention so that you will understand everything that you need to know about the candlestick pattern. There are several patterns or chart patterns to read the price on a chart, but the Japanese candlestick happens to be the favorite for most traders, as many traders are using the Japanese candle to trade the forex market, because it helps us to be able to read the price chart and know what the market is going to do or what the market is doing. So now, before we start with the candlestick pattern, we're going to look at some important key notes before we talk about the candlestick pattern. So we're going to look at how the candle is being formed, the Japanese candle. Remember that if you open a chart using Japanese candle, you will see that there is series of candles comprising of two colors, red and green. So the red color symbolizes bearish momentum, while the green color symbolizes bullish momentum. So we are going to look at how these candles are being formed. So there are four data points that makes up a candle, a candlestick. There are four data points that makes up a candlestick. We have the open, the high, the low and the close. So the open is the opening of a price, the high is the highest level that the price has gotten to, the low is the lowest level that the price has gotten to, while the close is the closing price. So let me show you an example of what I'm talking about. So this is what I'm talking about. This is clearly what I'm talking about. So we have two candles that forms consistently. Like I said, we have the green and the red. The green is a bullish momentum candle, while the red is the bearish momentum candle. So now, like I said, we have four datas that make up a candle. We have the high, close, open and low. And the same here, we have the high, open, close and low. Right? So these are the things that makes up what? A candle. So like I said, the high is the highest point, the highest level that the market reached before it reversed, right? That is the highest the market reached in a day or at a particular time frame. Now the close is where the market closed before a new candle opens. And like I said, candles are based on time frame. We have the monthly candle, we have the weekly candle, we have the daily candle, we have the hourly candle, like the 4 hour, the 1 hour. Then we have the minute candle. We have the 30 minutes, 15 minutes, 5 minutes, and 1 minute. So the 1 minute is the smallest candle pattern. 1 minute is the smallest candle. So now, each time a candle closes, a new candle is being formed, right? So it depends on the time frame that you are trading. So for us to be able to read the candlestick chart very well, we need to look at the open, close, high and low of the candlestick, right? Now at the right side is the green candle, which symbolizes what? Bullish momentum, right? So in the green candle we have 4 components, right? 4 data points. We have the low, the open, the close, and the high. So this is how it works. The market opens here, right, and then went down. So this is the lowest point that the market went, then went up. This is the highest point that the market went, and then closes here, right? So we have open, low, high, and close. So for the fact that the market closes above the opening, it signifies that the market was bullish, because the market opens below and closes above, which means the market was what? Bullish. Then at the left hand side is a red candle, which symbolizes what? Bearish momentum. So at the left side here, the market opens at the top, right? The market opens at the top, right? The market opens at the top, while the buyers push the price little bit up, and this becomes the highest point of the level that the market got to, which makes it the high, right? Then the sellers step in again, then push the price all the way to this low, right? So this becomes the lowest point that the market got to, and then the market closes. So the market opens at the top, went up a little, then smashed down, and then closes at the bottom. So for the fact that the market opened at the top and closes at the bottom, it means that the sellers are in charge. It means a bearish momentum, right? Because the sellers are in control of the market. So this wick is what we call price rejection. We have the upper wick and the lower wick. So this wick is what we call what? Price rejection, right? You can see that the price got here and was rejected. So what forms a candle is the body, the upper wick, and the lower wick. So this is the body of a candle, this is the upper shadow, the lower shadow, right? So if the body is very big, it signifies what? A strong momentum, right? If the body is large, is very big, it signifies a strong momentum. So you can see here that the green body is very big. So this tells us that there's a strong bullish momentum here. And here you can see that the red body is very big. It can signify that the bearish momentum is very high. So this is how you read a candlestick, or how a candlestick is being formed. Like I said before, for bullish candlestick pattern, the open is always below, right, and the close is always above. While for the bearish candle, the open is always above and the close is always below, right? So this is what differentiates between the bullish and the bearish. So after that, we're now going to look at the candlestick patterns, right? The candlestick patterns that price action trader use to make money consistently in the forex market. So now we have 2 different kinds of candlestick pattern. We have the bullish reversal, and we have the bearish reversal. So candlestick pattern helps us to know when a price is about to reverse, right? Either from an uptrend to a downtrend, or either from a downtrend to an uptrend. So we have bullish reversal and we have the bearish reversal. So we are going to treat this one after the other. So pay clear attention so that you understand what this video is talking about. So now let's look at the bullish reversal candlestick pattern. The bullish reversal candlestick pattern signifies that buyers are in control of the market. It tells us that the buyers are in control of the market. That is what the bullish reversal candlestick pattern tells us. So it must be identified at an area of value. So what do you mean by an area of value? An area of value is a support or resistance level, or in other words, you can call it demand and supply zone. So you must identify a candlestick pattern at an area of value before it becomes active, right? You must identify it at an area of value, either support or resistance level, before it can be active. If you identify it any other way, it might not give you the reliable signal that you want. So that is why I said it must be identified at an area of value before it becomes active, right? So there are so many bullish reversal candlestick pattern out there. There are so many of them, but most of them are just rubbish. Most of them are just nonsense. So out of all the bullish reversal candlestick pattern, I've decided to pick out the 3 major ones, the 3 most reliable bullish reversal candlestick pattern that are more reliable. I've tested it so many times and they are very, very reliable. So there are 3 bullish reversal candlestick pattern that are very reliable. So the 3 of them are the hammer, the bullish engulfing pattern, and the morning star. Right? So we are going to look after them one after the other. So let's start with the hammer. The hammer is a 1 candle bullish reversal candlestick pattern that forms after a decline in a price. It's a 1 candle bullish reversal pattern that forms after a decline, that is after a downtrend. Right? So this candle looks like a hammer. That is why they call it the hammer. It looks like a hammer. So let me show you how the candlestick looks like. So this is the candlestick I'm talking about. This is a hammer. Right? This is a bullish reversal candlestick pattern that forms after a decline in price, after a downtrend. So if you are able to spot this candle at a support level after a downtrend, then you can be able to join the buyers and ride a new trend. Because when this candle is being spotted at what? At a support level after a downtrend, it signifies that a new momentum is about to resume. The market wants to shift from selling to buying. And if you're able to spot it and enter your trade when it is being identified, you can be able to ride a massive trend. Right? So what does this hammer symbolizes? Right? It symbolizes that there is what? A strong selling rejection. A strong selling rejection, and there's a strong buying in the market. So how do we mean? The market opens here. This is where the market opens. Right? This is where the market opens. Right? The sellers step in because the sellers were in control of the market. Right? The market was going down, 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 going down. Right? Then this is the new candle that was formed, because normally we have series of red, 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 red. Right? Then got here. This is the lowest that the market got to. They now form this candle. Right? So when this candle was formed, the sellers were still in charge. Right? Because you know that the market was in downtrend, right? And you know when the market is downtrend, the market is always going down, 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 down. So when the market got to this point, right, and this new candle started forming, right, the sellers were still in charge, pushing the price down. You can see the price was still going down, going down, going down, until the price got to this lowest low, right? And know that this area must be an area of value. This area must be an area of value, right? It must be either a support level, right? It must be an area of value, right? It must be a support level. So when the market got to this low at a support level, the market started to do what? Started to reject, right? That is why you see this long wick. So that is when the buyers now step in and started pushing the price up. So the buyers began to push the price up, 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 until the price got to this point, to this highest point, and closes above this point. So this symbolizes a bullish momentum. It symbolizes that the buyers are in charge of the market. So you simply wait for this candle to close, place a buy trade at the close of this candle, a stop loss will be below, and then you can be able to ride the trend. So this is how you trade using the hammer. So the next bullish reversal candlestick pattern that we have here is what we call the bullish engulfing pattern. So a bullish engulfing pattern is a 2 candle bullish reversal pattern that forms after a decline in price, right? So this one is a 2 candle that forms a pattern. The first one was a 1 candle, but this one is a 2 candle. So that is why I say a bullish engulfing pattern is a 2 candle bullish reversal pattern that forms after a decline in a price chart. So this tells us that the sellers are weak and the buyers are strong. So this is how it looks like. This is what we call a bullish engulfing candlestick pattern. So like I said before, this must be identified at an area of value which is support level, because the current market was formerly in a downtrend, right? Series of red, and the market got to the support level, and this must be a support level, right? This must be a support level because the candlestick pattern must be identified at a support level. So this must be a support level, right? So as the market was going down, and then got to this lowest point, the buyers now stepped in and began to push the price up. So you can see the red, the next candle that came out was red, which is the sellers are still in charge. So they pushed the price all the way to this low. And what happened? The buyers now stepped in and then began to push the price up to the extent that the price engulfs above the red, right? The price engulfs above the openings of the red and then closes above it. So once this is done, it means that there is a strong buying momentum in the market. It means that the buyers have stepped in and they are going to push the price higher, right? So for the fact that the green engulfs above the red, it means the buyers are in charge of the market. So that is why we call it the bullish engulfing pattern. So you wait for the green candle to close, you place a buy trade at the close of this green candle, and your stop loss will be below the support level, and then you can take your profit at the next swing high. So this is what we call the bullish engulfing pattern. So the next one we have here is what we call, but before we move into the next bullish reversal candlestick pattern, there is one thing you need to understand about the combination of the hammer and the bullish engulfing pattern. A hammer is usually a bullish engulfing pattern on a lower time frame, right? Because of the way candlesticks are being formed in multiple time frame. So if you identify a hammer at a higher time frame, it means you are going to identify a bullish engulfing pattern at a lower time frame. So a hammer will be identified at a higher time frame, while the bullish engulfing pattern will be identified at a lower time frame. So that's why I said the hammer and the bullish are the same, just that they are being identified at different time frame. So this is an example of what I'm talking about here. So now if you look carefully, you see that these are different time frames, right? This could be the 1 hour time frame, and this could be the 4 hour time frame, right? At the 1 hour time frame, you can see the bullish engulfing pattern, while at the 4 hour time frame you can see the hammer, which is a 1 candle stick, while this one is a 2 candlestick. So you can clearly see everything is the same, right? You can clearly see that everything is the same. You see that the market opened here, went down, right? And then the buyer step in and then push the price up. The price now closes above. So it's the same thing here. You can see that the price closes above the opening, right? So you can watch, you see that they are the same level. You can see that they are the same level. So once you identify a hammer at a higher time frame, you can be able to identify bullish engulfing pattern at a lower time frame. So that's why I say the hammer and the bullish engulfing pattern are the same, just they are being identified at different time frame. So after that, we are now going to move into the next one, which is the morning star. The morning star is a 3 candle bullish reversal pattern that forms after a decline in price. So a morning star tells us that the sellers are exhausted and the buyers are momentarily in control of the market. So the morning star has 3 candles, right? 3 candles are what we use to form the morning star. Why bullish engulfing use 2 candles and the hammer use 1 candle. So here is an example of the morning star. So like I say, the morning star use 3 candles to form the pattern. So like I say, this must be identified at an area of value which is a support level. So you can see that previously the market was in a downtrend, making series of lower high and lower low, lower high and lower low. So you can see that this was the last red candle that was formed after a series of red candle, right? So as the sellers were pushing the price, when the price finally got here, the market now began to consolidate. So here the sellers were still in charge. That is why I see this long red candle. So the market opens here and the sellers push the price down all the way to this low. So when the market opens in the next candle, there was what we call equilibrium. The market began to range. So you can see that buyers and the sellers were exchanging price. So the market goes up, comes down, goes up, comes down, goes up, comes down, goes up, comes down. So at this point, there was indecision in the market. The buyers and the sellers were struggling to know who is going to take control of the market. That is why you see the range. As the market goes up, comes down, goes up, comes down. And then what happened? The buyers won the battle. So there was a breakout of the range. You can see the highs of the range and the lows of the range. So the market now broke out above the high of the range, telling you that the buyers have stepped in. So that is when you saw this green candle, this long green candle, right? So this green candle is going to engulfs above this red candle and closes above it. So when that is done, it means that the buyers have stepped into the market and they are going to push the price up. So once you are able to identify this morning star at a support level, you don't need a prophet to tell you that the market is going to go higher. So you simply wait for this green candle to close, you place a buy trade here, the stop loss will be below the support level, and then you target the next swing high as your take profit. So after that, we are going to move into an example of how you can trade this profitably. I've shared with you the bullish reversal candlestick pattern, right? And now I'm going to show you how you can trade it profitably in the forex market. So before you do that, you must understand price action trading techniques. That is the market structure, area of value, entry trigger, and so on and so forth. So now let us trade this and see how it goes. First, you're going to open your price chart depending on the time frame you are using. It can be 15 minutes, 1 hour, 30 minutes, any time frame you are using. You're going to open your chart and then look at the market structure, right? Now, if the market is in an uptrend, right? If the market is trending higher, you have to wait for a pullback towards a support level. If the market is in an uptrend, you can do what? Wait forward, a retracement, a pullback at a support level, right? That is the first thing you have to do. You have to wait for a pullback at a support level. Then after the price makes a pullback at the support level, then the next you have to do is you have to wait for a bullish reversal candlestick pattern to form and close, right? So when a bullish reversal candlestick pattern forms and close, then make sure that the candlestick is very large, right? Signaling a strong rejection. Make sure it's large, signaling a strong rejection. So if you have confirmed that the candlestick is large, then you can now place a buy trade at the close of that candlestick. So this is an example of what I'm talking about. So you can clearly see that the market is in an uptrend going high, 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 right? Then the market now makes what? A retracement, because you cannot buy when the market is at the highs. You need to allow the market to make a pullback for you to be able to buy, because if you buy at the highs, when the market makes a pullback, it will take you out. So you wait for a pullback. So you can clearly see the pullback. Now the market makes a pullback at a support level. So this is a support level where the market makes a pullback at. Then what happened? The next candle that comes out was the green candle, and it does what? It engulfs above this red candle. So this is what we call a bullish engulfing candlestick pattern. So once this green candle closes, you place a buy trade at the close of this, and your stop loss will be below the support level, and then you target the previous high as your take profit. I hope you understand this very well. So now we are going to move into the bearish reversal candlestick pattern. We have talked about the bullish reversal candlestick pattern. We are now going to look at the bearish reversal candlestick patterns. The bearish reversal candlestick pattern signifies that the sellers are in control of the market, and like I said, it must be identified at an area of value, support or resistance level. But for the fact that this is a bearish reversal, it must be identified at a resistance level. That is what I mean by an area of value. So the candlestick pattern must be identified at a resistance level before it becomes active, right? There are so many bearish reversal candlestick patterns, so many of them, but we are going to look at the 3 most important bearish reversal candlestick patterns. These 3 are very active. They are very accurate. The signals are very accurate, right? That is why I decided to talk about them. There are so many, but this 3 is more accurate. So the 3 bearish reversal candlestick patterns are the shooting star, the bearish engulfing pattern, and the evening star. Now let's talk about them one after the other. The shooting star. What is the shooting star? The shooting star is a 1 candle bearish reversal pattern that forms after an advance in price, right? A shooting star is a bearish reversal candlestick pattern that forms after an advance in price. After the price has moved up to a resistance level, that is where the shooting star is being formed. So here is an example of how a shooting star looks like. So this is what we call a shooting star. An opposite of a hammer is a shooting star. So now you can clearly see that a shooting star must be identified at an area of value which is at a resistance level. So this must be a resistance level. This must be a resistance level. This must be a resistance level. So this is where it must be identified, right? So you can see that previously the market was in an uptrend, making series of higher high and higher low, higher high and higher low, higher high and higher low, right? And then what happened? The price now got to an area of value which is what? A resistance level, right? So when the price got to a resistance level, the price began to do what? Reject. The price began to reject. So the rejection here means the buyers are unable to push the price up, right? The sellers have stepped in and they are now pushing the price down until the price now closes below, right? That is why you see this long weak rejection. So the buyers were pushing the price up. So when the price got to the resistance level, the sellers now step in and then push the price all the way to this low, right? Because the price opened here, the buyers push the price all the way to this point, and the sellers now step in and then push the price all the way to this point till the price closes at the lows. So this signifies a selling pressure. It signifies a selling momentum. So the sellers are now in charge of the market. So what you have to do is you wait for this candle to close, you place your sell trade at the close of this candle, and your stop loss will be above the resistance level. This is how you trade using the shooting star, right? This is how you trade using the shooting star. So like I said, it must be identified at a resistance level before it becomes active, right? Like I said, it must be identified at an area of value before it becomes active. So after that, we're going to look at the next one, which is the bearish engulfing pattern. So the bearish engulfing pattern is a 2 candle bearish reversal pattern that is formed after an advance in price, right? In essence, a bearish engulfing pattern tells you that the sellers have overwhelmed the buyers and they are now in control of the market. So this is how a bearish engulfing pattern looks like. Before, the market was in an uptrend, making series of higher high and higher low, or making series of highs, 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 highs. And when the market got to this resistance level, the sellers now step in and push the price down till the price engulfs below the green. So this tells you there is a strong selling pressure in this market. It tells you that the sellers are active, they are very strong in this market. So this is a strong bearish reversal candlestick pattern. So once you identify this pattern at a resistance level, you simply wait for this red candle to close. You place a sell trade at the close. Your stop loss will be above the resistance level, and then you target the previous low as what? As your take profit. So this is how you trade using the bearish engulfing pattern. Now, just like the bullish reversal pattern, the bearish reversal pattern also has a similarity between the shooting star and the bearish engulfing pattern, right? So a shooting star is usually a bearish engulfing pattern on the lower time frame because of the way candlesticks are being formed on multiple time frames, right? So if you spot a shooting star at a higher time frame, if you go down to a lower time frame, you'll be able to spot a bearish engulfing pattern. So a bearish engulfing pattern at a lower time frame can form a shooting star at a higher time frame, just like a shooting star at a higher time frame can form a bearish engulfing pattern at a lower time frame. So this is an example of what I'm talking about. So now if you look clearly, you see that this is what we call the shooting star, and this two candles is what we call the bearish engulfing pattern. So this can be identified at a higher time frame, while this can be identified at a lower time frame, right? So you will see that the levels are the same. See the close, this is the lowest point, and this is the lowest point. This is the highest point, and this is the highest point. So you can see that this candlestick combination forms this candlestick. So that is why this one can be identified at a higher time frame, while this can be identified at a lower time frame. So you can clearly see that the bearish engulfing pattern and the shooting star are the same, just that they are being identified at different time frame. So that is what you need to know about the similarity between these two. So the next candlestick we have here is the evening star. The evening star is a 3-candle bearish reversal pattern that forms after an advance in price. So an evening star tells you that the buyers are exhausted and the sellers are momentarily in control of the market, right? So this is a strong bearish reversal candlestick pattern. So let me show you an example of how it looks like. This is what we call an evening star, right? So formerly the market was in an uptrend, making series of highs, series of highs, series of highs, and then when the market got to a resistance level, right? This is a resistance level. The market began to consolidate. That is why we have this doji, this plus sign. This is what we call the doji. The plus sign is called the doji. So this doji sign symbolizes what? A range, right? The market is in equilibrium, ranging at the up, right? So this is an indecision in the market because both the buyers and the sellers are exchanging price. The sellers sell from the highs and the buyers buy from the low. The sellers sell from the high, the buyer buy from the low. So there is an equilibrium between buyers and sellers. The buyers and sellers are struggling for supremacy, right? They are waiting for who will take over the market, right? And if the market breaks above this high, it means the buyers have won. And the market breaks below this low, it means the sellers have won. And then what happens here? The market now breaks below this low, and that is why we see this long red candle. So this long red candle tells us that the market has entered into a downtrend. We call it bearish momentum. So the market is in a strong downtrend. So the sellers are pushing the price down, right? So if you identify this candlestick pattern at a resistance level, it means that there's going to be a strong selling pressure in the market. So what you have to do is you wait for this red candle to close. You place your sell trade at the close of this red candle, and then your stop loss above the resistance level, and you target the next previous swing low as your take profit, right? So this is how you trade using the evening star. This is how you trade using the evening star. So now I'm going to show you an example of how you can trade the bearish reversal candle. How you can trade the bearish reversal candle. Just like the bullish, you have to look at an area of value. Like I said, an area of value is either support or resistance level. But before you look at an area of value, you must wait and see what the market is doing. You have to look at the market structure. What is the market doing? Is it going up or going down? But if the market is trending lower, if the market is going down, you have to wait for a pullback towards the resistance level. So if the price now makes a pullback towards the resistance level, the next you have to do is you have to wait to see a bearish reversal candlestick pattern form and close at that level. So once the bearish reversal candlestick pattern forms and close at that level, then you have to confirm if the candlestick is large enough to signify a strong rejection there, to signify or signal a strong rejection. So you must see whether if the candle are very large in size to see whether if they have strong rejection. So if the candle are very large, then that is the right time for you to place a sell trade. So this is an example of what I'm talking about. You can clearly see that the market is going up from here. The market is going up, right? So when the market now got to this resistance level, this is what we call a resistance level, right? So when the market now got to this resistance level, you cannot see this long red candle, right? The red candle engulfs below the green candle, right? This is what we call the bearish engulfing pattern, right? You can clearly see that the market was going up, and when the market got to this resistance level, the market got rejected. You can clearly see the red candle, and the red candle engulfs below this green candle. So this is a strong selling momentum. So what you will do is you place a sell trade at the close of this red candle. Your stop loss will be at above the resistance level, and then your take profit will be at the previous low, right? So this is how you trade using the bearish engulfing pattern. The same thing applicable. You can also use the shooting star. So here you can clearly see the resistance level. This is the resistance level because the market got here, rejected, got here, rejected, got here, rejected. So this is a resistance level. So you are waiting to see a shooting star. So here is what we call the shooting star. The market broke above the resistance level and then got rejected, ending up in the form of a shooting star, right? So this shooting star symbolizes what? A bearish momentum. So you have to wait for this candle that formed the shooting star to close. You place a sell trade at the close of this candle. The stop loss will be above the resistance level, and then you can now target the previous low, these lows, as your take profit. So this is how you trade using the bearish reversal chart pattern. So we have come to the end of this tutorial video on candlestick pattern. So I believe you have learned a lot from this video. Please, the favor I need from you is to subscribe to this channel. Give me a like if you love this video. Comment your thoughts on this topic. Tell me the kind of videos you want me to share, and I will do that. And also, please don't forget to share this video so that other people will get to see everything that we have done in this video. Thank you very much for taking out your time to watch this video from the beginning to the end. Please come back for more updates because I'm here to teach you on forex trading. So that is all I have for you in today's video. Enjoy the rest of your day. Peace out.